Welcome everyone to another week, another Tuesday of Investors Gallery. I want to thank everyone who was able to make it to Rare Cars and Real Estate this past Thursday. It was our last one for the year, and I think we did really well. It was a success in my eyes. So for those who are new and joining, let me tell you a little bit about myself and about Investors Gallery. So my name is Pressley. I am half Dimensional Capital Partners. We are a multifamily syndication, investment, and development group here in Houston. And I came up with the Investors Gallery because I actually built an art gallery in my home. I love art and I love all things man made and creative and craftsmanship and all that. And the idea was to shoot a podcast in my art gallery. The running joke is my office is about 95% and the art gallery is almost there. So one day I'll finish it, and we'll be able to do the podcast in the actual art gallery, but it's on the other side of the wall here. But I brought this podcast to fruition because I wanted individuals in the public to be able to meet amazing people like the gentleman I have today. So introduce yourself so I don't mess your name up again, and tell us what you do and how you got there, and teach us some stuff.
Sure, Presley. Well, it's a pleasure to connect with you and to be introduced to you. And I love the concept of your podcast, The Investors Gallery. I too am a fan of art. And so, I consider this us kind of spending time in your gallery together, talking about some of the things we love, which in this case, of course, is real estate. And so, thank you for inviting me and having me on today. My name is Sohail Hassan. I am one of the managing partners and principal at a private equity real estate firm here in Houston called Market Space Capital, which primarily focuses on the acquisition and construction of multifamily apartments. And so, I have two other partners. There's a guy named David Rodarte. He's been working in real estate his entire career. Started out fixing and flipping homes, worked his way to the commercial sector, and now obviously is focused on multifamily. And then the third partner is a gentleman named Dr. Masaki Oishi, and he's actually a practicing neurosurgeon here in the Houston area. And he's been while he obviously is practicing, he's actually been investing in real estate since he was about the age of 16. His family immigrated here from Japan, and he was the only one that spoke English well, and so they basically he was responsible for the family's investments. And so he's had a very successful career. He acts as the chairman of Market Space Capital. He is the author of a best-selling book, A Medical Professional's Guide to Investing in Real
I've
Estate.
seen that.
And yeah, so he's done really well. And so David and Dr. Uishi met in 2009. They made their very first investment together back in 2011, which was for a multifamily property here in the Houston area, which Presley you might be familiar with, right around I-10 and Eldridge, right in the energy corridor area of Houston. And throughout the years, they were acquiring, very opportunistic, right? Acquiring retail office assets. I met these guys in 2017. And at that time, I was exiting. My background was, working in politics at first, having worked on the Obama campaign in 2008. After that, I went to DC. I got a master's in political management, which effectively teaches you how to run political campaigns. And there's three tenets that they really teach you here. One is going to be on message and how to craft your message. The other one is money and how to fundraise. And the third is mobilization and how to get people to actually do what you want and need to do in terms of voter turnout. And those three same concepts are applicable almost to any major company as well. And particularly here in the real estate business, right, where you're having to raise and dial for dollars. I think that those are kind of some of the natural things that were taught to us there. And so ultimately, I came out of that with being very passionate about renewable energy, and having followed kind of the industry since I was in college at Texas A&M University, and understanding that this was going to be kind of the future in terms of the way we consume energy in this country. And so I spent 8 years of my life dedicated to the renewable energy sector. Started off with a huge project where we made a lot of money, invested that into some projects that didn't do well. Some were just, passion projects. Um, then, eventually founded a technology company related to the solar industry that we ended up exiting out of. And upon that exit is when I was looking to, deploy capital into real estate investments, and I was introduced to Dr. Oishi and David, and they had already done some successful investments together, but they were doing these as individual special purpose entities. There was no concept of creating a brand or a firm and raising capital. So that's what we decided to do. And that's when Market Space Capital was truly formed. And since then we really have grown. Again, we had at that time a focus on the retail and the office side, but right around the 2018, 2019 timeframe, we shifted and took a 100% focused approach on the multifamily asset class. And we actually, it's funny, we had 4 apartment complexes that we owned, and I'm sorry, 4 retail shopping centers that we owned, and 3 office buildings. We started exiting out of those, and the last retail shopping center we exited was in February of 2020, right before the pandemic hit. And so we were, blessed to be able to kind of get out of that those investments, because, as you may know, Pressley, during the pandemic, the retail and office assets really kind of took a big hit.
Big
And
hit.
in the Houston area, we're really impacted by oil and gas. So the oil and gas market was already kind of on a downturn. So we decided not to make investments into the office asset class. So we were primarily, the office buildings we were invested in are mostly like medical office buildings and things of that nature because of Dr. Oishi's network and connections. But we never really sought to go out and buy office assets. And I think this investment philosophy that we happened to make, months before the pandemic has been further reinforced, right? Because the multifamily asset class has been kind of one of the best performing, above, of course, retail and office, and perhaps right below industrial. So for that reason, it reinforced our thesis to just kind of double down on the multifamily sector. And so we have now kind of created 3 distinct verticals of our business, Pressley. The first one, of course, is around the value add strategy, which sounds like you're very familiar with, in terms of acquiring mismanaged or neglected properties, and most importantly, understanding that their rents are below market. So, of course, we invest capital into renovating those units and then putting them back out onto the market with a modest bump in the rents, right? So we've done this now successfully, and Dr. Wishi and David started this in 2011. We've done a total of 23 of these investments, these value add investments. We've gone full cycle on 15 of those. So we've kind of created a process internally, in order to be able to kind of create an engine to source and execute on these deals. And we've been really blessed because we can, of course, I always say that part of our business is threefold. One is finding properties that we want to put our own money into, right? Ultimately, it's like our own savings that is going into this. Secondly, being able to source equity to be able to take down those deals. And then the third is being able to execute on your business plan. Like, those are the 3 major components of our operations, as you know. And on the second one of that, because of Dr. Uishi and because he's a physician, we've really developed a robust network of high net worth physicians from all across the country that are looking to deploy capital with us. So roughly about 7,000 accredited investors in our network, of which, over 700, now about over 750 have actually converted into investing with us. So with that is how we've been able to really do this. And, on the value add side of the business, we do about 4 to 6 acquisitions per year. And, our latest exit was just July 15th of this year, where we exited 624 units. that were in the NRG area of Houston, which was about a $75 million exit. So, the value add continues to be our bread and butter. And, we put a team in place. I'm very thankful for the people that dedicate their lives here every day, right, to executing on this business plan. And we've assembled a great team, some of which, of course, you've met already. But aside from that, around that 2018, 2019 timeframe, Presley, we kind of evolved to getting into the ground up development side of the business, right? Once you've had a good footing into the value add, naturally we kind of went to the ground up development, and that, was so that we can continue to provide consistent, returns to our investors that they're expecting, right? And the deals that we're looking at from a value add perspective weren't necessarily penciling out. And so ultimately, we found a site here in Houston near Pearland, but it's actually, on South Post Oak and Beltway 8. But it is a 155 unit ground up development of a garden style multifamily complex. So, simpler product, one building, 155 units, 3 floors. And basically, it's a $22 million construction cost. And this is, our first foray into getting into the development side of the business. And, really, it's a learning experience, right? There's the unknowns that you can be as prepared as possible, but market conditions, certain things happen, and you just have to be prepared to go with it. And so that project is now under construction, and it's scheduled, units are scheduled to start coming online at the end of this year. So this will present our first kind of full, construction project where we've gone through the complete process. But along those lines, right around that 2019, 2020 timeframe, we started spending a lot of time in Dallas, and understanding that Dallas is one of the best performing real estate markets in the country. We started spending time, money, and resources there. And ultimately, we came across a site that is located directly adjacent to the Dallas Medical Center. It's called the spot at Myra Park. And this site, not only is it directly adjacent, when I say adjacent, I mean this site used to be a parking lot for the medical center, and we acquired it from the owners of the hospital. And so now we've been under, we looked at it. The site is right off 635 in Webb's Chapel. So, a major artery going through Dallas, 285,000 cars driving by the site every single day. So we jumped at the opportunity. We acquired the site in May of 2020. We have currently, it took us about a year to get permits and plans approved. We finally kicked off construction, and currently it is under construction. So it's 250 units. This is a core luxury asset, 5-story wrap podium style parking garage. This is a $65 million project. And it is scheduled, units are scheduled to start coming online between Q3 of Q4 and Q4 of next year. So those are really the two big ground up development projects. There's another site that we acquired in North Dallas that, initially it basically has like a 20-acre site with a 17,000 square foot mansion that sits on it. And so we really love the mansion, and we came up with this site plan that has, 220 units, and it incorporates the mansion there for like a leasing office and temporary stay.
Wow.
Ultimately, as we were kind of going through it, we were approached by DR Horton, who put it under contract to buy out the completed lots from us. So currently, we are expecting just to go horizontal on it, at which point we would exit, and then someone else would go vertical. So this makes up really the most of our second vertical of our business, which I mentioned to you, the ground up development. And then, of course, the final part of our business is the third vertical, which is made up of mixed use developments, right? And this is primarily, Pressley, made up of one enormous project. And this is for the repurposing of a shopping mall that is located in a city called Springdale, Ohio, which is about 20 minutes north of Cincinnati. And I'm not sure if you've ever been to Cincinnati or spent time over there, but it's a beautiful city. And we came across this opportunity, and not to say, Pressley, like, there's a lot going on in our own backyard. This Texas has been very busy, but this opportunity came into our laps, where basically, there's a shopping mall that's going through what all shopping malls across the country are going through, right? 2007, they had 98% occupancy. When we acquired the mall in March of this year, Pressley, it had 18% occupancy. So the
Wow.
Macy's, the Sears, the Dillard's, the J.C. Penney's all gone out of business. And so, the city, understanding that this is kind of the cornerstone of their community, right? It's been there for 60 years. Imagine First Colony Mall in Sugarland. It's akin to that. And so they didn't want it sitting there empty and dilapidated. And so they put together incentives for developers such as us to come in and repurpose the mall. And Pressley, those incentives were to the tune of $200 million in the form of what is known as tax increment financing, or TIF. So we have now, taken over this mall. And Pressley, typically when you look at these mall acquisitions, there's two things you look at. One is there tend to be a number of owners involved, like 8 or 9 different owners that own like a big parcel. So there's like, it's a headache to deal with everybody, right? In this case, we have 3 owners. The first owner was a Chinese company based out of Singapore. The second owner was the Macy's parcel, and the third was a Sears parcel. So we negotiated between all 3 of them, and we basically acquired this mall, which sits on 75 acres of land. And Pressley, there's a saying that says if you're looking for good real estate, look no further than shopping malls, right? They're strategically located, and they have the ability to capacitate a large amount of people, right? Particularly during like the holiday shopping season. So, this is no different. Now, the second issue with the shopping mall acquisition is that there's typically a high saturation of residential surrounding it, right? So, like, think West Oaks Mall in Houston, right? One of the reasons why it's sitting there empty and unfortunately cannot be repurposed because there's already a ton of apartments and housing right around it. In this particular case, the city of Springdale, they 32 years ago, they basically passed a moratorium that did not allow new multifamily development to come in. And so as a result, it's kind of created this pent up demand for multifamily housing. And so we have been entitled for up to 2,600 multifamily units. Imagine, Pressley, I mean, these are numbers that are coming from the city telling us that after they did their analysis, this is what they think that this area needs and should support. So that's an enormous amount of units and a huge project for us, right? So we ended up going through and acquiring this. And as I mentioned, in March of this year, we became the proud owners of the shopping mall. We are now going through a complete transformational change on this property. And just to give you an example, all right, here in this case, and this is something that we're trying to answer every day. What is the value of this property, Pressley? Okay, currently the shopping mall has 3,178 parking spaces. Majority of that coming from 2 structured parking garages and then some surface parking. And so you can imagine, I'm building a parking garage in Dallas right now, and it's
Right.
costing us right under like $22,000 per parking spot, right? Parking garages are expensive.
Yeah.
And so in this scenario, let's say we take a conservative value and say $20,000 per parking spot. If I take that times 3,178, I mean, you're looking at like 70 to 80 million dollars of imputed equity just in the parking spaces alone.
Right.
Again, it's valued at zero to an empty shopping mall, but to our development, I don't have to pay to build that,
Right. It's
right? So
priceless.
that's a huge savings to us. You got it. Okay, then let's talk about the infrastructure of the mall. I mean, this was an open shopping mall. It had a Foot Locker, Cinnabon. I mean, you could go to visit whatever you wanted up until May 15th of this year when we shut it down. And so the mall was in great shape. So we, think there's about $100 million of infrastructure just in the mall itself, right? The utilities, the water. I mean, the mall and our plan is to basically repurpose 85% of that, right? So not only are we green from not putting this into landfills, but we're basically doing our work is going to be doing interior finish outs.
Right.
So really cool stuff. And then kind of the final element when you look into these mall things, you know, is the public funding that's available. Now, again, I mentioned to you, we've been approved for a $200 million TIF. And for those of your listeners that aren't aware, basically it's, done through your property taxes, right? As you pay your property taxes, some of it's going to the city. And in this case, the city is then giving us some of those funds to repurpose it. And really, Presley, those are going to like infrastructure costs, right? To change the streets, to relocate power lines and things like that. It's not going into our pockets, it's all going to the project.
Right.
But those are costs that we would have otherwise wouldn't be able to pay to make this development successful. So the city knows that they have to be able to front some costs in order to make this, a not only a successful investment, but one that is paying property taxes and in turn can then generate more revenues for the
Right.
city.
Right.
So it's kind of an investment from the city's perspective, right? But that's only the tax increment financing. There's other public grants available for that we've already qualified. New market tax credits in the form of $30 million, Ohio air quality grant, EV infrastructure, state and federal funds that are coming from there. I mean, we estimate, at a good 40 to $50 million of additional incentives that are available to us. So Presley, here we stand where, we've now come up with a total value of somewhere around $400 million for this investment. And Presley, we were fortunate enough to buy in at a very low cost basis of only $37 million. Wow. So the upside on a particular project like this, I mean, if you look at it from our business, Presley, of doing multifamily, we would have to do 20 of these multifamily projects to be able to just get to the returns that we're offering on this type of shopping mall redevelopment. All right. And part of it is that like everything is under one entity, Tri-County Repurposing LLC, and all 75 acres is in that one entity. So immediately we're breaking that up and we're putting that into 22 different entities. So there's an outlying parcel that has like Starbucks, Men's Warehouse, Chipotle, all of that is going to go into its one own entity and be refinanced off. And we're basically doing that to these different parcels. So that's ultimately the basis of our value add strategy. From there, it's, bringing in the different retail, the multifamily component, the green space, all that is just additional on top. So with that being said, that's a little bit about myself, Market Space Capital, and some of the projects that we're working on. And I'd love to answer any questions or, take a deeper dive into any of these projects that you might be interested in.
All right. Interview's over. Thank you. No, no, you did a great job. Obviously, you can clearly tell that you have experience, and you've done this a few times. Through all of my interviews and speeches or whatever I get thrown into, I try to point out the gold nuggets. The biggest gold nugget that I want our viewers, and probably even more so our listeners, to catch was not the fact that you guys are experienced. It's not the fact that you're successful. I think if someone rewinds this recording and they just listen to what you said, why you said it, and how you said it, they'll understand how to pitch through storytelling, because that's effectively what you did. Not specifically and not maybe necessarily intentionally. It's always going to be a little intentional, because that's why you're on here, is to brand yourself and let the public know, hey, I'm a safe bet. My company is a safe bet. But for those who are on the capital raising side or the investor relations side, what you did was very well done, very polished. Being in this seat and being in the same industry, I look for and listen to different things. I know how deals work. I know what tips are, and it's still good information to give the viewers, but I'm listening to how you crafted that story to say, hey, here's why this need was developed. And this is just happens to be the money that's associated to it. But from this story and from these benefits is how you're able to get such an amazing return. Because people don't want to hear or don't want to be sold. They want to hear benefits. They want to know how can their being in their everyday lives, and in our case, their money, benefit you, therefore benefiting themselves. If I have money and I want to pour into your investment or put into your investment, a lot of people don't realize that they don't want to hear, if you give me $100,000, then this is the return. They want to hear, this is why this need was created. It's a dying mall, and explaining that story, and this is what you're doing, and we're repurposing it. So I salute you, sir. That was very well done. I have 16 million questions from from your speech. One question, kind of going towards the beginning of the interview or the conversation, you said that you guys, or the doctor and his partner, had special purpose entities. Were they SPACs, or were they just entities dealing with only certain asset classes?
Yeah, so every time first of all, thank you for everything that you said, and I hope that even if there's even one tidbit of value that your listeners get out of this, then I think we've accomplished our goal. So appreciate everything that you said, and our we've been very open from the beginning in sharing how we've been able to succeed, and hopefully bringing in other sponsors to be able to do the same thing. And of course, we've learned from the people. I've been attending boot camps, and took what I learned from there and implemented it into our business. And as you know, Pressley, every day we're improving ourselves, not only professionally but also personally, right? So that's kind of the goal here. So thank you for saying that. But to answer your question, I mean, the way that we've been able to, every new property that we're acquiring, we're essentially creating a new entity, right? So that entity is specifically dedicated to that specific property. Okay. So before, all of those were being done as, the property's name and maybe the address, LLC. Now we decided to do kind of everything under the market space capital umbrella. So if you look, it just makes the org chart that much more complicated. But ultimately, it makes it to where Market Space Capital Holdings is the owner of everything, right?
Is it a series LLC?
Yeah, it's just a Texas-based LLC.
Okay.
That Market Space Capital is, and then underneath that we have ownership into a holding company, and the holding company is actually owns all the GP interest to all of our deals.
Okay, so it sounds like either a series or a master LLC or some variant of it. Okay. Are you the capital raiser?
I am, yeah. Out of the three of us, I'm kind of the responsibility of
obviously, right?
But I'll tell you, Dr. Oishi and David both also, it's a team effort, right?
Yeah.
So ultimately, we work together to be successful, and we have people on our team, just like Josh King and these other guys that.
Josh is a beast, by the way.
Beast. There you go. Yeah.
Hats off to Josh.
Good, yeah.
So how did you know, and this probably a little bit easier question for you because of your background, but I'm gonna ask it anyway. How did you know that when you entered into this partnership, that not only just capital raising was kind of the role that you were going to fall into? Because obviously, if you're coming from a political background where, one, you have to raise capital, and two, you have to have the same amount of skill sets. How did you know outside of that capital raising is what you wanted to do, and what is different between raising capital for multifamily and doing syndications versus political raise?
Oh, great question. I don't think anyone has ever asked me that, but I'll tell you, it's much easier on the real estate side. When I worked for the Obama campaign, it was an interesting time because this was, I take you back to November of 2007, and this is a full year before he had run for, or he was running for president, and I basically showed up in Chicago. I had just graduated from Texas A&M University with a degree in poli-sci and was ready to go to law school. Had this opportunity to join the Obama campaign, so went to Chicago And on the very first day, I met President Obama, and immediately was enamored, and knew that this guy was going to be our next president. And so came back to Houston, packed up all my stuff, and moved out to Chicago, and spent the rest of the year up until November of 2008, working to help raise funds and elect him our president. And so at that time, it was really interesting because it was the first candidate in which, it kind of changed the paradigm of how we raise money in the industry. Typically, you have a low amount of donors that are contributing large amounts of capital, but this is the first time where it kind of flipped everything on its head, and you had a large amount of donors now donating a small amount of capital. I mean, the average donation size to President Obama during that election cycle was something like $6, right? And so you're looking at,
Wow.
such a small amount, but he did it in such an enormous volume.
Right.
And of course, this is the advent of the internet. So this is the first time that the internet was really used to raise capital as well. So imagine hundreds of millions of dollars were coming in. And at that time, it was relatively easy, because you had such a transformational candidate like President Obama. But I'll tell you, with other investors, I mean, with other contributors, it's not as easy, right? Especially if you don't have the name recognition as a candidate. Whereas with real estate, I mean, it's kind of different because you're giving them a return on their money, right?
Yeah.
They're actually investing in something. So it's really seen from that standpoint. But you alluded to this earlier. I mean, we take it very seriously, right? We ultimately are the stewards of these people's life savings, even our own, right?
Yeah.
And so, our entire team is dedicated to implementing that business model and making sure that we deliver on the results. And we have, right? On the 15 deals that we exited, we had a 31% IRR that we averaged to our investors. And I think, part of that, of course, is like the hands-on management approach. And then part of it is because we've been lucky due to the market conditions, right? So we're about to see now who the real operators
Yes.
as we start going through, some very tumultuous times.
Yeah, I hear so many comments. I don't know if I was talking to my partner or a friend, and I was talking to somebody in our space, and they were saying one of their friends, somebody in one of our circles, could raise money over the weekend. We have friends in the industry who were consistently doing $20 million raises plus between Friday and Monday. And they will send out an email, and Monday they're oversubscribed.
Wow.
And now, those same people, even though, as far as I know, all of the exits have been, pretty good. They're not getting those same responses. A lot of people are being fearful and, doing what people do in a quote unquote recession. What have you seen in the markets as far as you raising money right now? Have you seen a huge shift, or is it just a little bit harder? What's been going on as far as your investors?
So I will say that, okay, the story I often say is that the evolution of a private equity real estate firm is that the partners kind of start out with, their own capital, and they prove the model, right? Once the model is proven, then you kind of go out and start raising capital from outside investors. Typically, it starts with friends and family. Then ultimately, you get to kind of a point where you're attracting retail investors, which is kind of where we were around that 2019 timeframe. But at some point, you become sophisticated enough, Presley, and you know this, where you start, attracting institutional capital.
Yeah.
And we've been, fortunate enough to have an introduction to the largest broker dealer out of South America that we met in
Wow.
2020, and it's an organization called FINSA, and they basically, contacted us and heard me at speaking at an event, and we met afterwards, and basically they said they're looking to deploy capital into U.S. real estate for South American investors. So after spending a long time cultivating the relationship, they came down here, met with us, visit all of our properties. We ultimately signed a teaming agreement to be able to deploy $150 million of equity over the next 3 years. and about $30 million of that equity has already been deployed into a variety of our deals. But as a long answer to your question, I would say two things, right? One is that institutional capital, they have their business is to deploy funds,
Yeah. Right.
right? That they have to. So no matter what, they're looking for investment vehicles in which to do so in no matter what economy it is. Now, in
Yeah.
this economy, they might, of course, and we have to look even more so at the underwriting and understand the fundamentals of the property. But an interest rate or an increase in interest rate can't be the deal killer. If that's the case,
Right.
then it's not a good deal in the first place,
Right.
right? And so that's kind of the answer that I would say there. The second part of this is that this is all cyclical, right? There has to be downs in the market so that there's ups, right? And so we know we have to plan in that. Now we've been fortunate enough for the last 10 to 12 years, since the 2008 global financial crisis, that we haven't been in a down market. But again, in those down markets are really where opportunities are seized.
Yes.
And the final point I'll leave you with is this: is that on the retail investor standpoint, real estate now more than ever is the most attractive asset class, right? You're not gonna if you had $1 billion, Presley, you're not gonna put it into the stock market, right? There's way too much volatility there. Now there could be opportunities that are going to be happening in the market, but you're not going to put all your money into that, right? Because
Right.
it's simply too volatile. So where else are you going to park your money beside real estate? And
Right.
as you know, in our industry, man, if there's the market is not doing well, I mean, we just continue to cash flow the asset and give distributions to investors on a quarterly basis, and they're happy,
Yeah.
right? But if the market conditions, once they do come back around, and that's when we would be in a position to then sell the asset.
Yep.
So that's why it's one of the most beautiful investments, man. And it's something I always say, it's like tangible, right? You can go and touch and feel it, right? People
Yep.
live there, they're paying their rents. So for those reasons, we continue to be very bullish about multifamily. And I will tell you, it's slowed down, right? The deals have slowed down. The amount that are people are selling, acquiring. When in this latest offering that we had the webinar for this evening, it's 738 units with two properties here in the Houston area, and it's about a 27 or 26 million dollar equity raise. But even putting it out to our investors, I mean, we have about 80% of that already committed. So I would say it is slowing down from a number standpoint, but there are still investors out there, Presley,
Yeah.
that have to deploy capital, and they understand that it just sitting in their bank account is not even keeping up with inflation at that point, right?
Right. Right. I will tell you from my experience within the last probably I really want to say 3 weeks, 2 weeks to be safe. My deal flow has jumped exponentially. Prior to the 3 weeks, I was getting a lot of deal flow from Kentucky and Ohio, New York, a lot of Rust Belt deals, and then a light switch flicked or something happened, and I sent my partner a screenshot of my email before I got on the podcast, and I think within 2 hours I had 8 deals sent to me. Um, some Rust Belt deals, but Cali deals, Florida deals, some Texas deals in there, and I'm like, I don't know what happened. So I'm sure to pick up on your side as well, and it also might be that you guys are, your heads down and you're working, and not saying that we're not, but when you're working on, you have the Ohio project, the Cincinnati project, and then what you also have here currently. So yeah, you guys are kind of busy, so do you guys tend to 1031 continuously? But how does that look for you guys as far as the exits?
Exactly. Yeah, we definitely want to avoid capital gains, and so we set up a 1031 structure. And not on all of our deals, like some of them. This one we are accepting 1031 exchange funds, uh,
Hmm.
as we are also deploying some of that capital from a previous deal that we exited. But I will tell you that the deals that we put in offers for that were turned away have now come back onto our table, and either the previous buyer fell out of contract or was not
Hmm.
able to close.
Yeah.
So understand, because again, they're doing it on such razor thin margins that if there was a small fluctuation to the interest rate, it kills their deal.
Yeah.
And so it fell out of contract. And so when they came back to us, we offered them, another $2,000 less per door, and now they're entertaining that deal, right? So again,
Yeah.
it was. I think there are opportunities that are about to come up. The question really is, Presley, is in the next 6 months, is it going to get worse, right? Because it takes time for the market to react to what's happening here.
Right.
And we've already seen positive improvements. I mean, as you mentioned earlier, I mean, part of our job, I think, in being in these leadership positions is just educating yourself on the market.
Yeah.
So I dedicate the first 30 minutes or so of my day just looking into what the market is and reading different articles. And so, understanding that the measures that the Fed is taking right now are having a positive impact, and that it's finally trending back downwards, inflation that is. But how long is it going to take?
Yeah.
And what reverberating impact is it going to have on the rest of the economy?
Yeah.
And so we know that there's going to be another increase at the end of the year. The question is what does it look like next year? And if there's no reprieve from that, then I think we're really going to start seeing blood in the water and deals that are going to come up for next to nothing, you know?
Yeah. Yeah, I've been seeing that as well. I've been seeing, especially because we're here in Houston, um, so many deals, and I'm like, that deal doesn't pencil, and somebody got it, and then I see the deal come back a couple months later, and I don't understand. And I've heard so many, not so many, but I heard of there a few operators who they just have to do a deal because they have property management, in-house property management they need to take care of, and they need the syndication fees. And we're my team, and I obviously your team are. I'm thankful to be blessed to not have to do a deal to do a deal. And
Yep.
if the deal doesn't look good, keep walking. We're okay. We can still eat. We can still pay our bills. We're still okay, and we'll find one that makes sense and benefits not only us but our investors, because that's the other half of the reason why we do this. Um, I truly believe we could have a 3-hour conversation, but I'm not Joe Rogan. I try to keep them to about an hour at least for now. But I do want to hit on a couple of personal notes
Sure.
because I like my audience to see the full picture. So going um, into the real estate, transitioning from the political life, um, how does the finances look from being a capital raiser, being on a campaign trail financially for you, versus how does it look and feel? You don't have to give any numbers, but what is the difference, or is there a big difference?
Oh yeah, huge difference. I mean, when you're working on a campaign trail, you're getting paid pennies, right? Literally a salary of like $60,000, and that's you have to be able to survive on that. Real estate was very different. We paid ourselves a very basic salary starting off, and really incentivize the team to perform well. But even now, all of the successes that we have are being reinvested into the company to be able to grow them. And that's how we bring on great team members like Josh, and other members of our team to help, expand, right? Right now, we just put an entire team together to dedicate full time on the Ohio project, simply because we want to make sure that we have boots on the ground. I mean, this is the biggest project in our entire portfolio, right? And so now we have, around the clock. We got a house over there where our members stay together in the house. We're there almost 2 to 3 weeks out of the month. So it requires an investment from that standpoint. But I mean, if the question is it much are you much better off in real estate from a financial standpoint than you are working on political campaigns? That's the answer is a resounding yes.
Yeah.
Um, I would say if you're working in political campaigns to make money, that's probably not the best motivation to do it, because at least on the grassroots side, there's not a lot of money. Maybe in running those political campaigns, or ads, and being a part of the ad buying start.
Yeah.
As you know, there's ton pouring tons of money into it,
Yeah.
especially in this election cycle. But unfortunately, those aren't benefiting, the actual constituents.
How would you say you've grown and changed as an individual coming from a political campaign trail to multifamily?
Well, I would say that being on the side of trying to help people, ultimately, we're supporting candidates that are trying to serve these these underserved, otherwise other underserved communities. And often they're marginalized. Um, they're put in positions where they're set up to fail, and we're seeking to help those communities, right? And this goes back to kind of the tenets of what my family has instilled, what our religion instills in helping others. And I think this is a natural part of that, in that our mission statement as a company now is providing affordable and safe communities for our residents to live in, right? And because of my background in renewable energy, there is an element to that of making these assets as sustainable as possible from an energy efficient, water efficiency, renewable energy, perspective. But ultimately, we're providing what everyone needs to survive, which is going to be food, water, and a place to live, right? And we take that very seriously, and we invest and, like I mentioned, dedicate our lives every day to trying to improve these communities. Ultimately, that's what we're doing. We're investing millions of dollars, some of it of our own,
Yeah.
to improve these communities.
Last question, and then I'll see if anybody has questions. Um, if not political campaign trail and not multifamily, what else do you think you would do and have a passion for?
So, as I mentioned, I would love to be in a position to serve others. Ultimately, being in a role of, philanthropic, giving to other organizations. My family has always been about that, and so ultimately, creating a foundation of sorts where we can support philanthropic opportunities, or organizations around the world. So I would love that would be what I would love to dedicate my life to.
Yeah, we're gonna be best friends. I like a man with a great heart. That
No,
those
I
are some
appreciate
really
that,
good
man.
friends.
Thank you,
I
man. I
see if
look forward to the
anybody
opportunity of
has.
meeting you in person too.
All right, so I am going to um, unmute you guys. Before we let Mr. Sohail
Yep.
go, anybody have any questions or comments? All right. So this will be dispersed. So the full video will be on YouTube. The full audio will be on 15, 20 different podcast sites. And then you will also be, obviously we're on Facebook Live, and it will also be on LinkedIn. So yeah, you're gonna be everywhere.
I appreciate that. Thank
in
you for all
any
your efforts. And Presley, one of the things that we didn't get into in this conversation, and perhaps we can schedule a separate conversation to dedicate specifically to that topic, is to the tokenization of real estate. And I'm not sure if
Mm,
you're familiar with that concept, but
yes, it's been
basically,
popping up.
yeah. So, using blockchain technology in order to, change the way that these investments are structured.
Hmm.
So we actually, you know, a funny story, when David Rodarte, myself, and Dr. Oishi met for dinner in 2017 for the very first time, the conversation was about how we can use real estate to disrupt how we can use technology to disrupt the real estate
Real estate.
industry.
Yeah.
And at the time, we were really talking about blockchain, but of course, understanding that it was in its infancy, we kind of took a wait and see approach to it. But ultimately, around 2020, we put a team together internally that was dedicated to understanding what the benefits are, to implementing tokenization into a real estate investment. And ultimately, we went down the road. And if you recall the project I was telling you about in Dallas, the
Yeah.
250 unit ground up development over there, we have actually tokenized that project, which
Really?
from our understanding is the very first uh, ground up development project that has been tokenized in the country.
Hmm.
So, these traditional methods, you would sign a subscription agreement with us and you're locked into that partnership. But you own a subscription agreement that says you own, 50,000 units of this LLC or whatever it is.
Right.
In this case, we would issue you 50,000 tokens. Each of these tokens use what is known as a stable coin. So one token equals $1, and there's no fluctuation or volatility like there is with Bitcoin or Ethereum. So basically, Presley, you would have this 50,000 tokens of yours in a digital wallet, similar to like a Charles Schwab account. And after 12 months, the SEC says that those tokens become what are known as unrestricted. And you're allowed to now exchange and sell those tokens on a secondary market.
Hmm.
So what this does is in the previous scenario, in a traditional real estate investment, you're locked into that. There's no liquidity. Inherently, it's an illiquid investment. Whereas now with tokenization, that is no longer the case because after 12 months, those investors have the ability to start trading those tokens onto a secondary platform. Now, listen to this, Presley. What gets even more interesting is most retail investors in the US, they typically can't afford a minimum of a $50,000 investment. And so they're, typically not able to buy into those types of investments. Something crazy statistic like 92% of the US population wouldn't qualify to be an accredited investor, right? Because they don't meet those qualifications. But now in this scenario, you have the ability to start fractionalizing those tokens. So those 50,000 tokens you own, you put them on the secondary market, and you can say, I want to sell 5,000 of these. I want to sell 10,000 of them. Now, somebody who, not only in the US, but in Japan, in Korea, in the UK that wants to invest in US real estate, now all they have to do is they come in, they buy these tokens, and now they become the owner of your LP equity into that deal. They start receiving all of the distributions now, and they start receiving all of the benefits that come with that investment from their end. So it's a beautiful thing. We have now implemented it into this first project, and perhaps as a teaser to our next interview, I'd love to come on and talk to you about kind of the cost benefit analysis that we put together in going down this route, and then take a deeper dive into the technology we're using and how we believe this is going to kind of be the way that these transactions are going to start occurring in the very near future.
Awesome. I will definitely make sure that this is the first segment that gets cut and put on LinkedIn. Um, Give the audience a way to connect with you. Um, the general website, because obviously since this is going on the internet, somebody's going to find us in 10 years and you might have exited some things. So give us a general website where no matter what investment you're in, you can always redirect them to what's current.
Sure. Yeah. If you just visit marketspacecapital.com, you'll see, not only the investments that we're offering, but a plethora of information related to everything that we do. As we do it, we're kind of writing these white papers and we're, sharing that with our community of investors. So we host, webinars. We have content that's, going out on all of the various social media platforms. So we encourage you to check out our website or follow us on any of those different on LinkedIn or on Facebook.
Awesome. Yeah, man, I can't wait for our lunch. We still doing mezza?
Yeah, please let's coordinate that through Josh.
Okay.
I think he threw out a date, but I don't know if it was confirmed.
We're
But
we're heading out
let's
of
get together.
town, and actually, I got my team on the call as well. We're heading out of town Thursday, so we'll have Julie and Josh connect, and get our schedules figured out.
Fantastic. Yep. And then I think that Josh wanted to coordinate a live networking event with you as well,
Awesome.
and we're sponsoring a couple of things. You're out of town for the weekend?
Yeah, we're not coming back till midnight Sunday.
Okay, gotcha. Excellent, man. Well, hey, what a pleasure connecting with you. Thanks again for taking the time here, and look forward to meeting you in person soon.
Yeah, I'm excited. All right, see you guys later.
Take care. Bye
All right,
bye.
bye.